As expected, the Reserve Bank of Australia has raised the cash rate for a record 10th consecutive time, hiking it by 25 basis points, which brings the official cash rate to 3.6%. The cash rate is now at its highest level we've seen since mid-2012, and importantly, Philip Lowe has clarified the central bank's stance on what's coming in the following months, implying a pause may not be too far off. After February's rate hike, Lowe shocked many pundits by saying that the Reserve Bank's board expected that there were further increases needed to ensure inflation returned to target levels. In today's announcement, Lowe's comments shifted and saying that we might see a pause in the months ahead. If you find value in this video, please consider hitting that subscribe button as it really helps out the channel. And a big thank you to all our subscribers for your support. It inspires us to create more content. So Jayden, what can mortgage holders do to minimize the effects of these rate hikes?
They have come thick and fast, and especially with the lag effect, you might only be realizing the December rate rise is coming through now because it can take the banks 2 or 3 months to actually increase your rates and pass it through to your repayments. The first thing I'd say is not to bury your head in the sand as much as you can. Try and get on the front foot. Have a look at what the new mortgage repayment is going to be in your situation and start budgeting around that. One thing we are seeing a lot at the moment is there's a bit of a two-tiered system where the banks, what they call back books, so their existing customers, interest rates are pretty different. There's a widening gap between what they're giving to old customers and what they're giving to new customers on the street because the mortgage market is incredibly competitive at the moment. So one thing we are taking a lot of steps to with our existing customers is we're contacting the existing bank and saying, hey, Mr. and Mrs. Bank, we've been a loyal customer, our client's been a customer of yours for 2 years. You're offering new customers out there 4.99% and their rate's 5.29%. That doesn't seem right. We want you to match what you're offering new customers or we're going to leave.
Exactly right. And we've had great success in that. We've had clients that were on 5.29%. The market rates at the moment are anywhere in the 4.89 to 4.99%. And we've had the bank being able to match that as well as give them a $3,000 cash incentive to stay without doing any paperwork. So it's definitely worthwhile asking the question. So I think that's the first tip. If you've had a mortgage with your bank for any more than 6 months, 12 months, 18 months, it's worth talking to your broker to review and seeing what you can do with your bank already. Jayden, let's say you've talked with your bank, they're not willing to help you. What are some other things that you can do? Is it making sense to fix at the moment? Should you refinance your loan? Are there incentives out there? What should you be doing?
Yeah, again, it's definitely worth getting on the front foot and you want to check out your mortgage capacity and potentially look at cashbacks and refinancing. There's a lot of banks out there that are offering $2,000, $3,000, $4,000 to switch lenders to offset the cost of refinancing. Generally, it costs about $1,000 to refinance from one bank to another. So you're going to end up ahead and you're going to end up with a lower home loan interest rate. So that's the first thing. We are seeing a bit more inquiry on fixed interest rates because, as you said earlier, there's been 10 consecutive interest rate rises over the last year, basically from May last year it started. It's come pretty thick and fast. And for a lot of people, it's caught them off guard. So fixed can be a good option because you finally have some stability. You're not going to keep getting those letters in the mail every month saying interest rate's going to go up. Nathan, what are the drawbacks of fixed rates, though, if you are thinking about going down that path?
I think we're going to be careful. We've seen Dr. Lowe's comments saying maybe there might be a pause in rate hikes coming soon. What that means is we might be reaching the terminal, the peak of where rates might get to. And then they're potentially, based on some of the bank's commentary and economists out there, we might see coming back on the cash rate in 2024. What the main thing we're talking about with our customers are, be mindful of the term you're looking to fix in for. If you're looking for a 3, 4 or 5 year fixed rate, maybe you're going to fix in at a high point, and then if the rates start coming back, you're going to be paying a premium to be in that fixed rate. 12 months seems to be quite popular with some of our customers. Some people have taken 2-year fixed rate options if they're really after that stability. But the main thing you need to think about is, one, fixed is great if you're looking for stability, but also you got to be thinking about what's ahead. What could happen? Could the Reserve Bank need to unwind a lot of this aggressive rate tightening? It's anyone's guess. We're not 100% sure.
Yeah, and I made this mistake a few years ago. So the interest rates were about 8%, I remember. They were forecast to go above 9.5%. I decided at that time, yep, I'm going to fix for 9%. Interest rate's going to keep going up. I'm going to fix for 2 years. Surely that's going to make sense. Unfortunately for me, though, it was during a period where they cut the cash rate aggressively. So it went the other way, where the cash rate went down. I was fixed at 9% and everyone else's mortgage rates were at 5%. So the downside with fixed in that case is you pay a break fee, or the difference between the 9 to the 5%, what the market is at that point, and it can be thousands of dollars. So keep that in mind. To Nathan's point, if you're fixing for 4 or 5 years, If you need to sell the property early, a fixed rate can be like a mobile phone contract, and if there's any years left, if there's 2 or 3 years left, you have to pay exit fees for that. Be mindful of that. There are some downsides.
It's anyone's guess what's going to happen in terms of the cash rate in the longer term. But if you are thinking of fixing 12 months, 2 years, we're still seeing it making a little bit of sense. The 2 years is starting not to make so much sense, particularly if the cash rate is going to peak in the next 2 rate hikes. But it's important to talk with a broker. So you can talk with someone like ourselves where we can examine your situation and see what it looks like. Jayden, for those looking to get into the market, this rate hike is going to mean another 3% off in terms of borrowing ability. We're seeing borrowing ability coming right down. What are some things people can do to maximize their capacity now that they're finding these rate hikes have really diminished the amount they can lend?
Yeah, there's lots of different things you can do to help increase your borrowing capacity. You can potentially look at reducing credit card limits that you've got. Even if you don't use a credit card, the bank will base their assessment on the actual limit. So a $10,000 credit card can reduce your capacity by $50,000 to $60,000 depending on your income. You can look at other things like HECS, education debt, personal loans, even your living expenses. You get different types of income over time, for example, bonus income. Some banks will take that as a part of your capacity. Others won't, as long as it's ongoing. So there's different things there where a mortgage broker like us can help look at that.
And what about if you have an investment property? No doubt you're feeling the pinch. Is there anything you can do there to minimize those repayments?
Yeah, we're seeing a lot of debt restructuring at the moment for people that have investment properties from 1 to 5 to 10, depending on their situation. One thing we are seeing a lot, which really fell out of fashion while interest rates were at historic lows, but is coming back, as looking at interest-only terms. On an investment property, it can make a lot of sense if you're trying to build up your cash flow, use that, and you can use the extra money instead of having to pay principal on the investment properties towards your home loan and help get rid of that debt. There's a couple of different strategies there. It's obviously general advice. If you want specific advice, definitely reach out. We can look at your situation and see what's going to make sense for you.
Here at Hunter Galloway, we get mortgages approved. There's no cost for our service and we deal with people Australia-wide. So if you're looking for a great mortgage broker, call us on 1300 088 065 or visit our website huntergalloway.com.au and we'll see you next time.